Hi everyone, can you hear me there? My name is Jodie Pedersen. I'm from Perennial. Thank you everyone for joining us today to discuss how we're finding opportunities in the microcap sector. I am joined here with Andrew Smith, who's the portfolio manager of the Perennial Value Microcap Opportunities Trust. And he is here to share with us more about the portfolio and what's been going on. Andrew has been with Perennial since 2008, and he is the head of smaller company research, head of the Microcaps Fund, he's head of research. So he's a wealth of information, and we're very spoilt to have him here, as we are spoilt to have you signing in and the people here in Sydney in person as well. A little bit about Perennial. Established in 2000, Perennial has $5 billion under management. We only focus on active management in the Australian equity space. We run a number of strategies in this space, including the fund that we're going to talk about today. Before we jump in and get into the good stuff, just two little points of housekeeping. We have a questions tab, which you should be able to see on the GoToWebinar tab right now. And feel free to answer questions here at any time. And the other piece of advice is, of course, that we are not financial advisors, we're investors. So everything we speak about today is of general nature only. You've always got to focus on and assess what works best for your personal situation. So with that, I am going to get started with Andrew. Can everyone hear me here? Excellent. Okay. Well, I'm hoping that's all right. So let's jump in.
Excellent, and thank you everyone for your time today. Particularly pertinent, a couple of topics I want to cover today is risk management. Obviously, with markets doing what they're doing this month, really important to talk about risk management and how we do that here at Perennial Value. So good timing in that regard. And equally, as Jodie mentioned, you can ask questions throughout, just on the internet there. If we see them pop out, we'll try and answer them during the presentation, but equally any questions that are left over we'll cover off at the end, so jump in with any questions. So I'll start off with talking about why microcaps. What is it that excites us about microcaps? And my personal experience with microcaps is so it goes back to when I was in stockbroking. That's a while ago now. So after the dot-com crash of 2000, I started my career in broking, and that was in small and micro caps end of the market. And I always liked the fact that if you did your own work, did your own research, you could come up with really good ideas that not everyone in the market was talking about. So versus large cap stocks or really hot stocks that you might jump in a cab and the cab driver's telling you all about it. I love finding those stocks that no one's talking about, that are doing really good things, growing earnings strongly. And as an investor, you can buy shares before the rest of the market appreciates what's going on. So that under-researched nature of the market still exists today. In fact, it's a couple of things that mean it's probably a better opportunity today. There's less brokers covering stocks. So Goldman Sachs put out some data, and there was 14,000 estimates in the market, and that number's dropped to 1,000 estimates. And despite that, there's almost 2,000 companies listed that meet the definition of microcaps. So we've got a very big universe that's getting less coverage from the brokers, so becoming more inefficient, and that's how we make money for our investors. So it's an inefficient sector. We've been doing microcaps as part of our small companies fund for many years. So when we look at, we've got 10 years of history. If anyone sort of needs it, they can contact the team. 10 years of history of small caps, and we can look at the microcaps within that 10 years of history and see that we're quite good at adding value in microcaps. It says they're 11% alpha per annum, so that's excess returns above the market per annum for 10 years. And on the back of that data, we decided we'd launch a dedicated microcap fund for the first time in February last year, and we'll run through the numbers so far, which have been very strong since we launched that. The other reason I like microcaps is it's very easy for them to grow the business substantially. So you compare it to, say, something like one of the banks, National Australia Bank, for example. Very hard for them to even get 5, let alone 10% growth, just by the law of large numbers, whereas some of the companies we're looking at can make meaningful investment decisions that can see them grow at 50 or 100% for many years. And if you're getting in early into these situations, you can enjoy some really strong earnings growth and stock price performance. But with that comes risk, and so I will cover off on the risk component because that's really crucial as well. With this fund, we can do something a bit different to what we've done in the past as well. We can get into pre-IPO positions. So that's investing in companies before they float. So this might be 6 to 12 months ahead of a successful IPO on the ASX. And typically when we're doing that, we're helping the board shape how the float should look. We're getting a discount, most importantly. Between 30 and 50% is the typical discount we get on the IPO price. And we've had a really good experience in selecting those companies. We've got about 6 in the portfolio at the moment. And we looked at about 90 opportunities before we selected those 6. And we'll be able to talk a bit about some of them today. And importantly, when you look at our performance, the strong performance to date, none of that is from the pre-IPO opportunities. They're all carried at cost, and they'll be coming to the market from now until March next year. Most of those opportunities will float. So I'll jump straight into the comparison with the large cap end of the market, which everyone's more familiar with. So when you look at large caps, the top 100 is 100 stocks, as you'd expect. The biggest stock in that index is 8.5%, and the top 10 account for almost half of the top 100. So very concentrated large cap into the market. And think about it as the banks plus a few resource stocks, and you get half the market. When we look at small caps, there's almost 800 companies. When you talk about microcaps, it expands out to 2,000 companies. So immediately you've got a very diverse set of companies. And then you look at the small cap index, which is what we benchmark ourselves against. The biggest stock is only 2% of that index. So it's much more diverse. And with all the Royal Commission things have been going through the last few months, really important to point out financials there. 35% of the top 100 is in financials, which is banks. There's no banks in the small cap index, and definitely none in the microcap index. So those big headwinds that have been facing that sector aren't relevant when we're talking microcaps, and that's helped some of the relative performance of late. I talked a bit about how the research nature of microcaps. Having been a stockbroker, I know it's very hard for brokers to justify covering microcaps. They don't trade a lot. They don't typically need a lot of capital. So we see that most microcap stocks aren't researched by the mainstream brokers, and that's what creates the opportunities. Whereas the large cap stocks, often you can have up to 10 analysts on one stock. It's very hard to get an edge on the market when there's that many people covering the stock. It's a very big universe, close to 2,000 companies, and I certainly wouldn't profess that I could manage such a big universe just by myself. So we've got a very big team. I'd argue we've got the biggest and the best team in the market in small and micro caps. And pleasingly, we got an award from Zenith just a few weeks ago for the best small cap fund in the market in 2018. And that's a really good vindication from a third party on the strength of our team. And we have been growing this team recently. So I'll talk about some of the key people here as it relates to microcaps. Sam Berridge, who you can see up the top there, he's based in Perth. He's a geologist by background. He's been with Perennial over 6 years. Having someone on the ground in Perth, literally today he's on a mine site, touring one of the lithium operations. Having someone on the ground there in a network of all the mining executives, it really helps us to add value in that sector if we think there's money to be made in resources. At the moment, we're more skewed towards gold. We've gone a bit defensive, and those gold stocks are actually performing quite well this month. But equally, if there's opportunities in other sectors, whether it's copper, iron ore, Sam's in a great position to be able to add value for us there. And a recent addition would be Ryan. He came across from another fund, joined us. And what I really liked about Ryan was his experience in the pre-IPO market, which we've talked about in terms of structuring those deals. And he covers a lot of ground in the technology space. He's literally just got back off the plane 2 days ago from America, where he's visiting a whole bunch of best-in-breed technology companies and also visiting some of the pre-IPO companies we've invested in. Marnie, she specialises in healthcare and agriculture, where we've got a few investments in the fund. And an example of some of our company contacts, she just got back from an industry conference just this morning in the agriculture space. One of our key ideas just put out a very positive update. That's Long Table, which you may not have heard of. Hopefully you'll be seeing more of their brands come to market on the East Coast, and Maggie Beers is one of their brands that you probably would have come across. So they put out a positive update today, and Marnie's done a lot of research on that one for us. So we've got a big universe, 2,000 stocks. You need a big team to cover it, and we do a lot of company visits. We did over 1,200 company visits last year, and that's crucial to our investment process. We find that getting in front of management, meeting competitors, suppliers, middle management, we really build up good knowledge on the stocks. So it becomes more than just a stock code moving up and down each day. It becomes a real business in our eyes, and that helps our conviction when we're investing our clients' money. One thing to point out, we are invested in the fund. That's voluntary. The fund was seeded by myself and Damien, and we've still got all money in the fund. There's no personal trading outside of that. So if you want to buy a stock and you're a member of the small companies team, you can't buy any stock on the ASX. You have to put your money in the funds, and we pay full fees, same fees as anyone coming into the trust today. I think that's really important to align the interest, because if there's a great idea out there, it has to go into the fund. A lot of our peers don't do that, so I challenge you to speak to some of the other fund managers about their policies on that. And what are we looking for? The reason I put this stock up, it's actually too big now to go into microcaps. It's sort of gone the full journey, and that's why I think it's a good example. So Navigator, you may remember the name. Its previous name was HFA, which did have some prominence in around sort of 2007, 2008. It was one of the high-flying stocks, poorly managed. But one thing they did manage to do was buy an excellent business called Lighthouse Partners, which is a fund manager out of the US. Through that acquisition, the managing director, Sean, became the biggest shareholder. Fast forward to sort of 2013, what had happened? Well, we were looking at that business as early as 2008 and just thought there was too much debt and we didn't like management. Fast forward 5 years, the chairman was stepping down. They'd been paying off their debt. There was a private equity firm that tried to take them over. So we knew there was a bit of interest in the space, and their earnings had started to come through. When we bought the stock in 2013, there was no brokers covering it. And so we were able to aggressively buy the stock on what was some pretty good news they announced in January. We were able to get set in the stock before the rest of the market really twigged to it. So this is all public information. If you did the work, you could work out that this was a very, very cheap stock. It was yielding about 15% dividend yield at the time. And this is all US dollar earnings. So with currency falling, that yield was going to go up. Over time, obviously, people in the market became aware of it. They sold their loss-making Australian business. So right now, it's just 100% Australian, 100% US business, sorry, which is good given where the currency is. And it's gone the full journey and now has 2 major brokers covering it. You know, a firm like Macquarie Bank now covers this. So that's obviously going to help the re-rating. It's gone back into the small cap index. It's now gone past the 500 mil cutoff for the microcap fund. But I think this is just a classic example of, if we like a stock, we buy it when it's under researched and we'll ride the whole journey. And in this case, it's a journey which is not over yet. We still own Navigator in our small companies fund, but that was a 5-year holding period and a very good returns for our investors. Another example from the past would be TPG Telecom, which we bought when it was called Solpats Telemedia. It was about 400 mil market cap, and as you know, that's gone all the way into the top 100 and is a very big company now. So these are the sort of ideas we're constantly looking for, and hopefully in the microcap portfolio today, we've got a few stocks that will look like this in 5 years' time. So how do we manage such a big universe? And this is crucial. Got close to 2,000 companies. How do we get this down to a portfolio of 60 to 70 stocks? As I mentioned, we do a company visit program that's very rigorous. So 1,200 companies we visit a year. That's a good source of ideas. We've also got that big team I showed you before, and every analyst covers between 40 and 50 stocks each. They have to go and build models on all these companies. And from that, we work out, does this company have good balance sheets? We've met management. Do we trust them? Do we know them from other board seats? And then we look at what sort of earnings growth we're forecasting. And if it ticks all those boxes, then it becomes eligible for investment. Importantly, when we look at those 2,000 companies, the first thing we do is reject 1,600 of them. So there's a lot of bad companies out there. There's a lot of very risky companies with too much debt, dishonest management. And, you know, we've been in the market a long time. So a lot of these companies are known to us under previous names, previous directorships, and you screen them out. For example, if they've got poor balance sheets, we might screen them out. but in a year's time there could be a capital raising, and that might fix the balance sheet, and so then it might become eligible to invest in. So we come up with 200 stocks that are modelled in detail and got fresh estimates on, and from that we're picking between 60 to 70 stocks. You might wonder why you'd own so many stocks, and that's part of the risk management which I want to speak to you about today. In microcaps, things can take longer than management think. Things can go wrong. Risks are higher, so we spread our risk across 60 to 70 names, and that's important, particularly in markets like what we're having at the moment. You've got liquidity spread across 60 to 70 names, and despite that, we're still able to generate some very strong returns. So we don't feel like we're trading off diversity returns via diversity. Importantly, we rerun this process every 2 weeks. So every 2 weeks, we screen the universe, we recheck, are we modelling high priority companies? And the analysts are always adding 1 or 2 stocks a month to their coverage list. The key outcome of this portfolio construction process is we want to pick the best 60 to 70 names we can think of at the time, and they're the best value names. We're a value fund, as our name suggests, so we always want our portfolio to be a discount to market. So as we went into this month, you can see our portfolio was a price to earnings ratio of 10.8 times. That compares to 15.5 times for the small cap index, a 30% discount. So material discount to what the market's trading at, and yet we're getting much superior earnings growth. And that really holds us in good stead when we get big sell-offs in the market like this. Our stocks tend to hold up much better, and that's certainly what we're experiencing this month. Talking to performance, we're off to a very pleasing start since February last year. As you can see, 71% cumulative return since February last year, and that's net of all fees. So whenever we talk about numbers, it's what you get in your pocket after all fees. On a 1 year number, we're up 42%. Again, coming back to risk management, clearly getting those sort of returns comes with risk. We manage our risk as best we can, but you will get down months when you're taking those sort of risks. And we recommend a 5-year time frame for someone considering investment in this fund. And certainly, when I sat down with my wife to decide about our investment in the fund, which is very substantial, that was money we locked away for 5 years, and we want to enjoy the capital growth over that period. To give you a live example of this month, the market's off substantially and down a lot today as well. We've fallen about half as much as the market, and that's even fallen less than the large cap market. So that probably is testament to our risk management strategy, the fact that we're buying cheap companies with good earnings growth prospects. They're performing much better than the average stock in the market today, and that's important for capital preservation. And I want to elaborate a little bit more on this. At the end of August, we were pretty concerned with some signals we were seeing in the market, and so we put this data out to our clients. There was a bunch of stocks. They were the most expensive stocks in small caps. They went on huge moves in August. So if you're looking on the left-hand side there's a bunch of technology stocks that are up, many of them up 40% during August, which is a huge move. And we looked at the earnings changes that those stocks had, they're only 1 to 2%. In the case of Afterpay, the earnings actually went down versus expectations. So a very unusual move in August. That pushed the multiples of these stocks, the PE ratio, which we shared with you there, to very extreme levels. You actually have to go back to 2000 to see the last time these small cap stocks, the most expensive group of small cap stocks, are this expensive. And we know what happened in 2000. And this was a warning we gave out in August, and we're really seeing some of these unwind now. So if we just update this group of stocks and compare it to the stocks we hold in the portfolio, we're also expecting earnings growth from these companies listed on the right-hand side. As you can see, the earnings growth is actually pretty comparable to those technology companies, but we're just paying a lot less. And interestingly, in the case of the mining services sector, they actually performed really poorly in August, despite delivering 20% earnings growth and being very cheap. In the case of SWIC, you can see there SWK, 9 times earnings, trades below asset value. So you can buy that business now for less than the value of the assets, and it's getting 20% earnings growth. But that's the stocks that no one wanted to know about in August. That was a great signal for us as a contrarian value manager. We were buying those names, SWIC and Index, IMD. We were buying these stocks while the tech stocks were running. We weren't chasing any of them. Fast forward to, now this is data I updated to last Friday. So these numbers will look even worse after today. There's been a huge sell down in these technology names. 25, 20% down from their peak, and yet they still look quite expensive. So in the case of APX, that's 27 times, WiseTech's 83 times. Now they came out with an upgrade today. It's only a 2% upgrade to earnings, and the stock's down because people go, you're still on 83 times earnings, you can fall a long way. And so I think it's still very early in this tech sell-off. By contrast, and this was the same group of stocks we showed in August, so we haven't sort of data mined this. Our group of stocks, with the exception of EML, they were all positive despite the market sell-off. And this was as of last Friday. And why is that? Because they're actually cheap stocks to start with, and they're delivering quite good news. So in the case of Index, IMD down the bottom, they had an AGM which spoke to 25% earnings growth in the first quarter. PWR, which is the best performer this month, up 19%. They had an AGM last week which talked about some really strong interest they're having in some new products they're launching. And they're an engineering firm that is really world class and is selling into electronic vehicle space as well as Formula One racing. It just shows how high end their engineering solutions are. It's got 23 times PE there in 19, but we see 50% growth for the next 2 years. So that PE drops pretty quickly as you look out in time. Some other examples from our history in the short history of the Microcap Fund. As I mentioned, Sam's based in Perth, and he's constantly scouting around for good ideas in the mining sector. This idea initially came from one of the directors he knew from another company. As he does, he's based in West Perth, so he's catching up for a coffee. And the director said, have you had a look at Galena Mining? It's actually trading below what the asset value, the plant and equipment is. So not everyone wants in the ground, which is obviously the most important for a mining company. It's trading at less than the value of the equipment that's been put on to process lead. In this case, it's a lead mine. So not one of the fancy commodities that everyone was talking about last year, which was lithium. This was lead, which no one was talking about. Sam was able to buy this at 7 cents as they started delivering some exploration results. And I'll remind you, Sam's a geologist, so he was able to interpret these results really quickly and work out that this is good news. And despite the stock doubling from 7 cents, he was still buying more at 13 cents on the back of how strong this data was. And then he started taking some profits towards sort of 24 cents there, having doubled his money. Why did he lock in the profits? Well, these results were so good that he determined that they would need more capital to further grow the asset. They now re-rated to where the asset value of the plant and equipment was. So the value had played out. We're buying a stock below asset value with no upside factored in. We sold it when it was trading at asset value with some good news starting to come into the share price. We got another chance to trade the stock in at 14, out at 17. And I hope that just shows you our value discipline. We don't fall in love with any stocks. If it reaches our price point, we'll sell it, move on, and find another good value name. Another name which you probably are familiar with is Kogan. This was a fascinating stock that it was a very poor float. So it floated probably in 2016 from memory. It was very hard for them to get the float away. Russell Kogan, the founder, didn't sell as much as he wanted in the float because that's how poor the reception was. And we didn't participate, but we kept watching it. And actually Damien, who's part of the team, picked up on this idea. They actually upgraded twice since the float. So earnings were going better than what they told the market they would be. No one cared. The stock just kept drifting down. We went and met with management and were really impressed with their data analysis particularly. Amazon was sort of all the rage in terms of launching in Australia back in 2017. Obviously, it's taken a fair bit longer. They're only just launching now. And the stock was getting sold off on the back of that. But we thought, actually, if you look at the UK, you look at Canada, those examples where Amazon's gone into the market, the existing players actually did better because everyone's more comfortable with shopping online. It becomes part of their daily process. So that with those examples and with the upgrades that we were seeing, we bought a position in Kogan. And there was some good news that came through towards the end of 2017. Despite the stock being up, we actually thought, well, this idea has gotten better than we thought. The earnings are going better than we thought, so actually we're buying more. And then the same thing happened in the February result, we're buying more. And it wasn't until the stock had done really well, as you can see, it's up almost 4 times our initial investment. At $8, we started selling. Why was that? Russell Kogan, the founder, started selling a material amount of shares. And we have a saying, if they're not buying, they're lying. And with
Good saying. I like that one.
the opposite applies.
Yes.
If they're selling and they can find something better to do with his money. He was buying Melbourne property, he was telling us. Well, if he thinks selling Kogan and buying Melbourne property is a good idea, maybe we should sell some Kogan and find something better to do as well. So as you can see there, we've exited. Now, this is not updated sort of live share prices, but that stock's continued to drift lower since. So hopefully that just gives you a sense of our sell discipline. As much as we like Russell, and I think he's a great data analyst and has built a good business, at $8, we thought it was more than in the share price. Just a couple of names we still like that are in the portfolio. People Infrastructure, that was a float. And when they came and saw us, we really liked the fact that management weren't selling any in the IPO. They were just raising fresh capital. In fact, the managing director was putting in friends and families to the tune of $2 million. So $2 million investment from his friends and family, you know, he's pretty incentivized to keep this business growing and not have aggressive forecasts in the prospectus. Fast forward through our holding period, it's done really well. It's up over $2 today and is holding up pretty well in this market. More importantly, what do? Well, they provide casual labour to some sectors which we think are in structural growth. So aged care, the National Disability Scheme, they're a key supplier of labour to that scheme. And we haven't really seen the money that the government's put aside being spent in that sector yet, but that's starting to come next year. So next year and the year after look quite good for this company. They're the key provider, and as you can imagine, there's a lot of legal loopholes and training required to supply labour in that sector, and they've got a good lead on their competitors. So we really like management here. We really like the sector they're in, and it's a cheap stock still. It's, you know, around 12 times earnings, big discount to market. So we still like that one. PWR, I spoke about earlier. They provide very high-end engineering solutions. I visited the factory in the Gold Coast. They've also got a factory in the US, which I visited. And this is very high-end, high-margin. Basically, think about them as cooling solutions. So when you're racing a Formula One vehicle, as you can see, Red Bull's their biggest client. Not only do you need to cool the engine rapidly, but you need to do it in a way that doesn't impact performance. So PWR come up with designs that change every year to have better shaped radiators, better shaped coolant, lighter coolants to help the performance of the car as well. Every 0.1 of a second that comes off a lap time is worth real money to Red Bull, and they pay very high margin for this product. From that start, they've gone into supercars. So if any of you are lucky enough to afford an Aston Martin Red Bull car, unfortunately I'm not quite there yet. It's about £1 million. You'll find PWR is the cooling supplier to that, and the radiator, and also this huge trend to electronic vehicles creates a big need to cool batteries. And at the AGM last week, you can see this on the ASX, PWR put up a slide that talked to their deals with the original equipment manufacturers, so OEMs as they're called, and that's the like of Aston Martin. Porsche has been a client in the past and is now a client again. Ford in the US for some of their high-end vehicles. But what was really interesting is for the first time they've got a big potential contract with electronic vehicle manufacturer, and that's to cool the batteries. Because there's so much computer power going into these electronic vehicles, you need to cool the batteries, and PWR is the world leader in cooling. So we really like that one. And again, management are a big shareholder. We've spent a lot of time with them over the years. As I said, visiting. I'm also going to the US at the end of the month. I haven't seen the US facility since the float back in 2015. They've doubled the capacity in the US to deliver some of these projects. So going back there to visit on the progress for them. So we still like that one. If any of you in Sydney, Melbourne or Brisbane, you drive around, you would see the huge infrastructure spend that's happening. This chart that we've got up here, it actually misses quite a few projects that are still to come and a high likelihood of coming. Badgerys Creek Airport would be a logical one. There's been another project announced in Queensland since this chart was put together, and also another one in Melbourne. So we think that surge in infrastructure spend actually peaks probably 2021, 2022. So we've got a lot of years ahead of us, and we've identified 3 stocks that we think are a great way to play this thematic. And if you look at all those stocks down the bottom, not one of them is on more than 10 times earnings. And that's despite having 20, 30% EPS growth on our forecast. Acro, ACF, down the bottom left there, that was a float. When they came in, we were very impressed that Kennard's family were investing in the business. You know, Kennard's know a lot about hire market, as you'd expect. They were putting their own money in and putting a chairman in. So that gave us a lot of comfort that we were really aligned with a big investor in the company. The stock was very cheap, management were incentivized, and it's one of the rare examples where you're buying a stock off private equity and you think you're actually going to make money. It was the last asset left in the private equity fund. So it was between selling this asset, it was between the portfolio managers of private equity getting their performance fee check or getting nothing. They had to sell this asset to close the fund and move on. So we got this stock very cheaply. 20 cents was the IPO. It's over 50 cents still today. Been a great performer for us and one of our biggest holdings in the microcap fund. Veris is another one, VRS in the middle there. That does all the surveying. So every time it starts as early as Badgerys Creek Airport, they've been working on for a year doing community consultation. That's one part of the business. Now they're doing the surveying work ahead of actually digging dirt on these projects. So we expect really strong revenue growth for them. Interestingly, that's one of the stocks that's been caught up in the sell-off recently this month. We think it's just a lack of information in the market. There hasn't been much news. So we see that as an opportunity, and we've been buying some more. Finally, GCS has become a much bigger company. They merged with another company we also own called SRG, and they've really got an amazing exposure to infrastructure, both here and in the US. And the US is behind Australia in terms of its infrastructure spend, but we think there's more to come in the US. So just some examples for you of how to play this thematic in the microcap end of the market. And what we're really trying to show here is, unlike the large cap end of the market where you'd have to think about banks and resources, here you can think about all sorts of exposures. We've got healthcare, agriculture, engineering, any exposure you want. You can pretty much got a chance of finding it within those 2,000 stocks listed on the ASX. As Jody mentioned, Perennial manages over $5 billion. Small caps itself is $1 billion, as you'll see later. So we've got very good relationships with all the brokers in town. We're an important client of most of the brokers we deal with. And so when there is good floats, good placements, we get pretty good allocations, and we can help shape these deals often. We give feedback early on pricing and try and get the pricing set right. And there's an example of float that came on 3 days ago, Straker. They came on 3 days ago. The tech market's selling off, but we priced that so well, it's actually up 15% on its IPO price, despite the terrible markets we've got at the moment. Now, if they priced it on what they originally were trying to sell it for, I don't think that would have happened. We got the price taken down by 20%, so our investors are getting set at the right price, and that's worked out really well. Now, this isn't a huge driver of our performance. It's just a bit of the cream on top, these placements and IPOs. Most of our strong performance comes from finding stocks that are already listed that are just poorly researched by the market. One great example, and again, this stock was up yesterday on some terrific news. They got some funding out of the European Union for 4 million euros, so about 6.6 million Australian dollars, to take their technology into the cement industry in Europe. So what do they do? Well, this technology spun out of the CSIRO. The company has spent $40 million over 10 years getting it to this stage, and when they floated, I think we paid about 50 million. So all the sunk capital, you weren't paying much more than 10 years of sweat and money, funded mostly by government as well as the existing shareholders in Calix. And we felt we were getting at a really good time when this technology, which is basically taking magnesium oxide, which you can see them mining on the bottom right there, they process it, and that's Marnie, our analyst, just to give you the scale. She's standing in front of their processing facility down in Victoria. They process this magnesium oxide, and it creates a very porous powder that basically, if you put it in sewage treatment, you put it in algal ponds, it captures all the pollutants. So the application in the European Union so excited about is putting it into cement kilns and capturing the carbon, so having environmental benefits. So this is a company that's got world-leading technology, and really when we bought it, we were only paying for the application in the sewage market. Since then, they've launched agriculture and, as I discussed, the cement industry, and they have many more applications beyond that. We really like management as well, and they're really incentivized to grow this business. So this was a float that came on in June and performed really well for us. One of the stocks we've invested in pre-IPO, so they're just starting there. Literally, the prospectus hit our desk this morning for the proper IPO. So this will be coming to the market in the next few months. Is a company called Revison. Now, I must admit, when I first heard this idea, it was a bit outside my realm of knowledge. So luckily, we've hired Ryan, who you can see there. He just got back from the States on Monday. That's him in San Francisco, visiting the manufacturing plant for Revison. So what they do is make silicon chips, and they make very cheap, low-energy silicon chips and very fine silicon wafer chips. And this is what's needed as devices are getting smaller and using more power. You need smaller, lighter, more efficient chips to go through. And Revison manufactures the polishing equipment that's needed to manufacture these super thin chips. So it's a growing industry. We really like the structure of the deal they've proposed. As I said, we're invested in there before the IPO. So when it does list, we'll get a discount to the IPO price. It's been carried at cost, so you haven't seen anything in our performance yet. But when this does come to market, we expect a nice uplift from this holding. Ryan's come back with strong conviction in this one, plus another stock, which we probably don't want to talk about. We are invested in pre-IPO, but there's some opportunities to buy some more of that at the moment off some private investors. So we want to keep that to ourselves, so our investors can get as much of that as we can. Suffice to say, it was an excellent trip, and Ryan came back with a lot of ideas. And finally, I'll probably leave this current strategy slide up here, and I'll come back to it for when we want to ask questions. But really just a reminder here that we've got over 60 names in the portfolio. So I've done a lot of these presentations in the past where people have been tempted to run out and buy one or two of the names were suggested. We think the better way to do it would be, whether it's us or another fund manager, it is a full-time job in microcaps. Buying one or two names is quite risky. We prefer to spread our risk across 60 to 70 names. And there's just a selection of the names we've got in the portfolio at the moment. Finally, I'll just jump ahead to capacity. So the important thing about microcaps is to keep the size of the fund small. So we will be shutting the fund at 150 million. So no new investors will be allowed in the fund after 150 million. This slide says we had 89 million. It's actually 100 million today. So we'll be getting really strong inflows of late. So we anticipate closing the fund probably February, March next year based on the current inflows. And the reason we're doing that is to look after our investors. So the investors that are in the microcap fund, if it gets too big, it's going to be harder for us to get in and out of stock. So we want to keep it nice and small. As I said, I'm an investor in the fund. Camilla's an investor in the fund, as is Camilla's son.
Yeah.
That's his life savings. We want to look after all our investors and keep it nimble. We do have a much more capacity in the small companies fund. As you can see, we manage close to $1 billion there already for our institutional clients. The microcap fund is purely for retail clients, and we'll be shutting early next year. If there is of interest on the rest of the presentation, feel free to email Jody or Camilla, and we can run through the differences with our small and our microcap fund. But I'll probably close there for any further questions.
So I have a question here. What are your thoughts on like defensive microcaps? Is there such a thing?
Yes, there is defensive microcaps, and when we're thinking about what's defensive, we start off with the business itself. So what businesses have revenue that is predictable and it can grow independently of the economic cycle? So an obvious one would be healthcare. So two names we've mentioned there, actually three names we mentioned there. PolyNovo, which is a high growth company that's again, it's come out of the CSIRO, and it's great to see all this innovation coming through the Australian stock market. They're providing burns treatment, so it's an artificial skin into Australia, and now they're cracking the US market. Now that sales for that business are irrespective of the economic cycle. They're penetrating the US market.
Well, I guess the people who get burnt is not related to the economic cycle whatsoever.
No, it's unfortunate.
It's
the more
awful.
disasters there are, the more war there is, and the biggest client is the US government.
Yeah, I bet.
As you'd imagine. So that one's actually performed quite well this month, as an example. Integral Diagnostics is a radiology business. Unfortunately, we're all getting older as a population. Radiology is actually proven to be quite a good in the treatment of prostate cancer and early detection. So that's a growing revenue stream for them. The government's started to improve the regulations in that space, and we're seeing some growth there. So that's another holding in the fund, quite a big holding for us. And People Infrastructure, which I mentioned before. Most of the staff, casual staff they're supplying, go into childcare, aged care, or the National Disability Scheme.
Which again, the demand for that is not
Exactly.
related to the market as such.
Yeah, so that's how we think about.
Yeah.
But equally, we don't mind buying cyclical exposures if they're cheap and the balance sheets are good. So some of the examples of the mining services space, they're not defensive, they're cyclical.
Sure.
But we think we're in the right point of the cycle, and the balance sheets, to take Index, for example, it's exposed to exploration, but its technology delivers about a 60% margin, very high margin tools that they supply in the exploration space. We're only 1 or 2 years into a recovery, which will probably last 5 years, and they've got net cash on their balance sheet. So while the share price might not be defensive, we think the earnings are growing, and over time that's going to deliver good returns for us.
That'll come out in the wash, so to speak. Yeah, that makes sense. How about online here? Any other questions coming through? Okay, I've got a couple more here. I really liked that phrase you used, if they're not buying, they're lying. What are the things you're looking for in a trustworthy manager?
So a lot of it's as simple as sitting across from management, and they come through our boardroom, or we go down to visit them on site, and that's actually what we prefer, so you get a good feel for the business culture by doing that. So a lot of it's sitting across, keeping a consistent track record of what they said 6 months ago, what are they saying now, has there been any changes? So that's a way of measuring honesty over time. But the best way really is looking at their incentives, and are they aligned with us as shareholders? So if a managing director is aligned, his incentives say that he should grow EBITDA, but doesn't reference how many shares on issue he needs to do that. So he's just incentivized to go out and buy as many assets as he can, build the business up, and then get out. Whereas a managing director who's incentivized to grow earnings per share and is given shares as a result of that, his incentives are skewed better towards shareholder returns. And that's what we look for.
I mean, I guess that's what investors, like potential investors in this fund, could use the same mindset to assess you as well.
Yes, and that's exactly right.
That alignment is important.
Yeah. Hugely important. Incentives drive everything in the way humans behave, so that's a big focus for us.
Cool. Awesome.
What about allocation to microcaps in an overall portfolio?
Yeah, well, most advisors that we speak to, they want to have it as a small part of your portfolio allocated to microcaps. And I can sort of understand that, because microcaps is a more volatile part of the market. And we don't focus on income. That's something we should have brought up. Dividend yields, there is a dividend yield on the fund and the companies we invest in, but it's not the primary focus. We're really trying to grow capital. So, if you're potentially in a retirement phase, you'd want to have a lower allocation to microcaps just to grow your capital, whereas the rest of your portfolio might be focused more on dividends. So we've seen people have between 5 and 15% allocation, but it's really up to individual circumstances what's appropriate. But the fact that you're getting capital, not non-income, is worth taking into account.
Any more questions online coming through? How about you? Anyone here?
No, I think I'm topped up.
You're taking it all in? Excellent. All right, I have one last question. Are you seeing more new names enter the microcaps, I guess the microcap sector as a whole? Is that coming? Is that increasing? Is that decreasing? What are we seeing as the themes here?
Yeah, it's definitely a growing part of the market. Some interesting things we've noticed is it's getting very hard to list a company in America. So Revison, which we put up before, is a US business.
Yeah.
You need to be about $500 million market cap to list in the US, given all the compliance costs now. So we're seeing a lot of these companies come to Australia to list. Australia is a very big and dynamic market by world standards. So the choices used to be America, London, and now it's America, London, Australia. And we're seeing, and London's got some similar issues to the US. So we're seeing a lot of inbound, successful, mature companies. When I say mature, they're much more advanced than some of the microcaps we're seeing from the local market.
Sure.
Been around 10 years plus that are still growing. They're coming to the Australian market. So that's a really positive for investors in the Australian market. There's a much broader set of companies. So that universe is growing.
Growing and growing. That's
Yep.
awesome. And do you think you expect that to continue to grow, just as the cycle continues?
Yeah, I do, because the Australian stock market historically was pretty concentrated to those names I spoke about before, the banks and resources.
Big guys.
6 names gives you half the market. Now that's changing nicely over time. Australia's got a huge superannuation industry. We're world leaders in that space, so it's logical that offshore companies are going to come and list here, and we're seeing more and more of it.
Yeah, awesome. Well, is there any other last points that you wanted to make, Andrew, while we've got everyone online?
Probably the last thing for me is, markets like we're seeing this month is exactly what value managers enjoy. So we're actually turning up. We're seeing a lot of red on our screen. These are companies that we've visited, that we've modelled, that we know. We know that the managing directors just bought $500,000 of one of our companies yesterday. And when we're seeing these share prices dislocate, we think it's a fantastic opportunity to be buying. So, we're really, while it can be daunting, as a team and with our value approach, we actually really enjoy these markets as a way to deploy capital for our investors.
Yeah.
When others are selling.
Yeah, exciting.
Just to repeat, the fund is likely to close reasonably soon.
Yeah, we're sort of thinking January, March is when we'll probably hit our 150 million target, and then it'll only be open to existing investors. So that's important too for anyone on the call. A lot of financial planners have said to us, they want money to be able to move in and out with their existing clients. So if you're an existing investor, you can still put more money into the fund, and we manage the capacity then by every June we pay out any capital gains we've realised. So each June and if the fund keeps performing, there's a reasonable distribution out of capital, and that's a way of keeping 150 million capacity.
Great. Awesome. Well, for those who are online, I'm gonna wind it up now. I want to thank you for attending online and also for attending in person here in Sydney as well. And you will receive an email from Camilla or me with all the details about the presentation today and how to invest. If you've got questions, you have our contact details as well. So please, feel free to reach out to us, because that's what we're here to do. Thank you, Andrew, for your time this afternoon, and everyone have a great day. Thanks again.
Thanks, Jodie.
Are you looking?